Hello Internet, my name is Ryan Ingram and today we're going to be talking about localizing the housing crash of 2020. Recently I recorded a video about exactly how to find and buy foreclosures in 2020, and the views on that video have been steadily increasing, and I started thinking why. And anyone that knows me knows that I don't own a television, we don't watch TV. I deleted the news app from my phone. I disconnect as much as possible and as often as possible to really stay true to my focus. However, once I started putting videos out on YouTube, I often see what other people are talking about. And a few people have really been talking about this giant housing crash that's going to happen in 2020. And the only thing that I really want to contribute to the conversation is real estate investing is not like the stock market. In the stock market, if you buy one share of a company, then what's true in New York on that share is also true in California on that one particular share. Fortunately, real estate investing is not like that. You really need to kind of localize this conversation about a housing crash. Yes, there are national indicators. Yes, you can see unemployment or forbearance of mortgages, but most importantly, what's true in New York, San Francisco, Utah, New Mexico, anywhere in America in real estate is not necessarily true for the other areas. So for example, the market that I'm in Dayton, Ohio, we are already a depressed market, and we have been a depressed market for quite some time. I just put a duplex under contract for $25,000, and both sides are currently rented out. Now they're rented out below market, but nonetheless people are currently living there. So I cannot fathom a world where a duplex will ever be worth less than $25,000. Similarly, as much as I think I know about real estate investing, it isn't necessarily applicable to the entire country. So I often have people reach out to me from different states that want my opinion or tips on how to get started in their real estate investing. And while I can talk about broad theories, ultimately, the things that work for me here in Dayton is not necessarily going to work for the people in other states. So if you are thinking about investing in real estate, but you're apprehensive because everybody is talking about this impending housing crash, and what I would strongly urge you to do is figure out what market it is that you're looking to invest in and really focus on the metrics specific to that area. And the more that you focus in on a particular market, the more you're going to be able to get real facts about that particular area. Okay, so instead of reading these really broad national articles and trying to make decisions on the market that you want to invest in, you need to get really laser focused and hone in on the metrics that pertain specifically to your market. Now, rather than consuming a lot of national speculation or national statistics, I'm going to go over 5 things that I think you should really watch and constantly monitor to determine your local market and if your local market is going to experience a housing crash here in 2020. Now, one of the things that I have done since this pandemic started is I have kept in close contact with a bunch of landlords. And I think inside of my network, I can account for about 2,000 doors here in the area. And by and large, the consensus is mostly all of everybody's tenants are paying. Most tenants have not experienced any lack of employment or unemployment. Personally, on my 63 units, I know that we have only had a difficult time with 2 tenants. Now, it's worthwhile to note that those tenants were problems before this pandemic started, and they will likely be problematic after this pandemic is over. They're just currently taking advantage of the current situation and the current offers on the table, and they have set up a payment plan. So now, rather than paying their rent at the first of the month, they are paying it slowly over the entire month. I don't know how this is helpful to them, but nonetheless, they were problems before, and they're just taking advantage of the situation. After bringing that up to the other investors here in the area, they have largely agreed that the people that they're having difficult time collecting rent with now have also been problems in the past. But this local market is in good shape because the majority of everybody's tenants are paying. The second thing I like to monitor are market rents. Now, I think one of the cool things about being a real estate investor is the fact that a lot of times, even in recessions, rents don't necessarily go down. They don't go up, but at the same time, that market rent probably will not go down. So here in my area, there are a bunch of investors that are still rehabbing properties, and once those rehabs get on the market, they're able to beat the market rent for their recently rehabbed unit. I've recently rented out a property for $800 where the market rent, I even did a video about this property where I suggested that that unit would rent out for $600, and we just put a tenant in the property for $800. After I made that video, I talked to my property manager and they completely laughed at my speculation that that unit would be worth $600, and they now have a tenant put in at $800. So again, you can monitor this metric by talking to other investors, other landlords, other apartment complexes, and figure out, do they still have the ability to increase their rents? If they do, then I think everything is largely going to be okay. If they're able to increase their rents, then by and large, this is a good indicator, and at the time being, I would not be worried. The third thing I like to look for is the time a rental is on the market. So a lot of times I reach out to other property managers or other investors that manage their own properties, and I figure out once they list a unit for rent, as I reach out to the property managers or other investors that manage their own properties, what I'm looking for is when a property is listed, how long before somebody signs their application, puts down their deposit, and occupies the property. Here lately in this particular market, I know I recently purchased a property on a Thursday. We had it listed on Saturday and somebody moved in on Monday. So in this particular area, the market is still incredibly hot. Rentals are not staying listed for very long before someone moves in. My particular property manager, the lady that does all the leasing, she has been doing multiple applications and leasing out multiple rental properties every day. I think last week alone, on one day, she rented out 5 different properties, which is a big deal, especially for investors. So people are still moving, people are still going into properties, and the investors are still beating the market rents. So that third metric is the time on market. Now, the fourth metric that I like to keep an eye on is the market values of properties. Now, there's generally, in most markets, there's a difference between what an investor would pay for a property and what an owner-occupant would pay for a property. So the MLS, I keep an eye on both. And fortunately, here in the local market, the housing prices are continuing to go up. One of my insurance clients and also a fellow investor here in the same market has recently listed and got under contract one of his rental properties for $110,000. And this is in an area where historically the housing values would be around the $60,000 or $70,000 mark. So that's a giant win, and the housing values are still going up. Now, if you've watched some of the other videos here on my channel, then one of the main metrics that I really focus on is when I'm purchasing a property, I like for there to be equity already in the property. My sweet spot, I love buying properties for about 50 to 60% of the after repair or the market value. That makes me really happy because there's a lot of wiggle room. The market could go down tremendously before it actually impacts my bottom line. So as we're talking about these things now, I hope you can see that even if a recession does occur, monitoring these metrics, a real estate investor is really isolated from the actual market. So if the tenant base continues to pay their rents, then the investor is in really good shape. If market rents continue to go up or remain the same, then an investor is still in really good shape. If the time on the market isn't that long, then the investor doesn't have a high vacancy rate, or they don't lose much rents or gross income for their business. So the investor, still pretty isolated, still in great shape. If the market values are going up, staying the same, or if the investor just purchased the property at a significant discount, then the investor remains isolated and the market has to shift incredibly before he or she, whatever the investor is, feels the impact of the recession. And lastly, and this might be one of the more important metrics, is to stay in touch with your local credit union. Now, over the past 3 years, since my brother and I have been acquiring rental property, we've formed some pretty good relationships with commercial bankers in the area and our local credit unions. So since this pandemic started, I've actually had a few banks reach out to me and figure out if I needed any money, if we were buying any properties, or if we had anything in our pipeline that they could help us with. So what that tells me, and what they have confirmed, is that they are not done lending. Even though by and large the economy has slowed down, with all of the SBA money that went out. Yes, the commercial lenders were backed up for quite some time, but as that's slowing down, they're looking to get back into lending on real estate for real estate investors, which is a phenomenal sign. So since lending has not tightened up, especially on the local credit union front, it is still a phenomenal time to buy rental properties, especially if you can get them for significantly under the market value and you can rent them at or above the market rents. And since you have confirmed with your local network, not your local newspaper, but with your local network of real estate investors, you can have confidence that the tenants are still paying rent. So rather than being fear-mongered or having the media successfully make you think that the housing market is going to crash here in 2020, I would just start keeping an eye on all of these metrics. If you don't have access to a network or a bunch of people that live in this world, figure out where they hang out and then start hanging out with the people that are best in these fields and figure out what they're going to do. And if the housing market crashes, then what will their response be? Because a lot of these investors are in a phenomenal cash position. So if the market does crash, then the number of foreclosures will increase, and consequently, there will be more rentals purchased at drastic below market value prices, which ultimately is going to result in a giant win for real estate investors. So I'm very thankful that the views have increased on my videos about foreclosures, but at the same time, if you have been purchasing rental properties the right way, or if you are looking to get into real estate investing and you have your analytics, you have your criteria for investment properties figured out, then I would not be worried, apprehensive, or scared about investing in real estate here in 2020. Worst case scenario, you have a property that meets all of your criteria. Best case scenario, the market does take a downturn. You have the cash on hand to get greatly reduced prices and favorable terms from local credit unions that are still looking to lend on these types of properties. So rather than looking for articles that support your opinion or your hope for a housing market crash and sitting on the sidelines waiting for something amazing to happen, TikTok, then get out there on the playing field and figure out where the next rental property for your portfolio is hiding and figure out how to get it. Because at the end of the day, my favorite, I think it's a Chinese proverb maybe, the best time to plant a tree was 20 years ago. The second best time is today. So regardless on whether the market does crash or doesn't crash, be prepared, have your cash reserves, your analytics, constantly be analyzing properties and looking for your next rental. There's literally no reason not to. Don't be scared. Don't be tricked into caring about the economy more than you should. Rely on your numbers, rely on all of your research, create for your family passive income. So if you have any questions, want any additional clarification, then please don't hesitate to reach out or comment below. Thanks for subscribing, because this is what I love to talk about. And if you have any questions or want to see other videos, again, reach out. Thanks so much. Look forward to talking to you guys soon.